What if you could get a real leg up on predicting the stock market? Not with some huge team of Wall Street analysts or a basement full of supercomputers, but with the exact same machine you're probably watching this on right now. Sounds kind of crazy, right? I mean, it's the classic David versus Goliath story for our time. Your personal computer going up against the massive high-tech power of Wall Street. But what if I told you that some new research suggests that gap, well, it might be closing, and faster than you think. So let's dig in and see if your everyday computer can really outsmart the pros.
To get how this is even possible, we gotta understand the playing field. For a long time, there's been this huge hurdle that we can pretty much call the Wall Street AI gap.
And this really is the core of the issue. For years, the absolute best prediction models, these incredible mixes of machine learning and deep learning, have been total beasts. They are just power-hungry, demanding gigantic data sets and the kind of computer power you only find in massive data centers. I mean, look at this quote from one of the papers. These amazing tools are basically locked away. Their intense need for computing power means they're really only for the big institutions, which creates this sort of technological ivory tower that keeps these advanced methods out of reach for, well, most of us. But what if there was a better way? A smarter, more efficient approach? Well, that brings us to a potential game changer, an engine designed not for brute force, but for elegance and speed. Think about it like a boxing match, yeah? In one corner, you've got the heavyweight champ Deep Learning. It's incredibly powerful, sure, but it's also demanding and pretty slow. And in the other corner, you've got this scrappy up-and-comer called LIGHTGBM. It's built from the ground up to be lean, fast, and super efficient, exactly the kind of model that can run on a regular personal computer. So what's its secret weapon? Well, one of its cleverest tricks is called leaf-wise growth. A regular model, on the left, is like a detective who has to, knock on every single door on every single street. It works, sure, but man, is it slow. LightGBM, though, that's a smart detective. It finds the one most promising lead, the path with the most information, and follows that first. It's just a much, much faster way to solve the puzzle. All right, so we've got our fast engine. But an engine is nothing without fuel, right? So how do we give this AI the good stuff, the premium fuel? The answer is all about adding a secret sauce. Now, this secret sauce has a fancy name, feature engineering. But don't let that scare you. The idea is actually super simple. It's the art of being a data chef. You take your basic ingredients, like a stock's open, high, low, and close prices, and you get creative, combining them in new ways to cook up much more insightful clues for the AI. And we're not just talking about simple stuff here. The researchers got really clever with this. They started looking at things like the overnight price gap. That's the jump or fall that happens after the market closes. They created clues to spot when the price and its momentum are starting to disagree. They even measured volatility in totally new ways. It's all about giving the AI a richer, more detailed picture of what's really happening. Okay, let's recap. We've got a speedy engine, we've got some high-quality fuel, but there is one more critical step before we can hit the road. We have to take the raw, messy, chaotic data from the stock market and make it something a machine can actually understand. See, the thing is, AI models, they need consistency. They need to learn from stable patterns. Trying to learn from raw stock data, it's like trying to hit a moving target that's also changing shape on you. It's chaos. It's almost impossible to find a reliable pattern in that. And here, take a look. This is what that wild, chaotic data actually looks like. It's the raw price of Apple stock over time. See that clear upward trend? In statistics, they call that non-stationary. Basically, the whole baseline is always shifting. And for an AI, that is an absolute nightmare to learn from. But now, watch this. With just one simple tweak, we're just looking at the daily price change now. It becomes stationary. See? No more trend. It's just bouncing around a stable middle point. This is a playground where an AI can actually start to see what's going on. Okay, the stage is set. We've got our lean, mean, LightGBM engine, we've got our secret sauce of smart features, and we've tamed the data. Now, it's showtime. Let's put this thing to the test. Now, to be taken seriously, any new model has to beat the reigning champ. And that champ is surprisingly simple. It's called the random walk model. It's a tough opponent because it basically says the market is totally random, and your best guess for tomorrow's price is, well, today's price. In other words, it's a coin flip, a 50-50 shot. So, did our little engine that could actually beat a coin flip? Oh yeah,
big time. Get this. The model correctly predicted whether the stock would go up or down the next day almost 2/3 of the time. That is way, way better than a random guess.
And it wasn't just about being right on the direction. Check out this table. It shows how big the errors were. Lower numbers are better, obviously. Our model had a smaller average error, which is great, but look at that last column. That one really punishes big mistakes, and our model's score is way lower. That means it was much better at not being spectacularly wrong. That's a huge win.
Okay, so of all those clever tricks we added, which one was the MVP, the most valuable player? Well, this chart makes it pretty clear, and it's fascinating. By a long shot, the single most powerful clue was that overnight price gap. It's like what happens when the market is supposed to be sleeping is actually telling us the most about what it's going to do when it wakes up. So let's just pause for a second. A smart, efficient model running on a totally normal computer can make pretty darn good predictions. What does that actually mean for all of us? Let's zoom out. Are we looking at a future of smarter forecasting for everyone? You know, the big takeaway here is just really exciting. This is way more than just one cool experiment. It's proof. It shows that if you're smart about it, you don't need a supercomputer to do powerful financial forecasting anymore. And that brings us back to where we started. We asked if your home computer could outsmart Wall Street. And the answer is looking a lot like, yeah, maybe it can. But that opens up an even bigger question, right? What happens when it's not just your computer, but everyone's computer? When individual investors can all access these powerful tools, how does that fundamentally change the world of finance? What happens when that ivory tower finally comes crumbling down?